Welcome to the Deep Dive. We're your shortcut to understanding the big shifts happening around us.
And today we're tackling something huge, really inevitable.
Yeah, the collision or maybe convergence of traditional finance, TradFi, and blockchain, specifically real-world asset tokenization, RWA.
Right. It's basically taking stuff you can touch, well, sort of. Things with real off-chain value anyway. Think big office buildings, government bonds, massive markets,
Right.
even complex private credit funds.
And putting them on a blockchain, representing ownership as a digital token, programmable, verifiable.
Exactly. And the key thing for you listening is this isn't some far-off prediction anymore.
No, we're way past the science project phase. This is happening now, institutional scale.
Think about it, the value of tokenized assets already on-chain, and this isn't even counting stablecoins, which is its own massive thing. We're talking somewhere between, what, $24 billion and $30 billion.
That's a serious number. It's not trivial. So our mission today for you is to really unpack this.
Yeah, we need to get into who is driving this, who's building the infrastructure, the rails for this. Why are giants like BlackRock, like JPMorgan, pouring billions into it?
And we need to look under the hood a bit. What tech actually makes this possible for complex finance? And maybe most importantly,
The roadblocks, the regulation, the legal stuff. What needs to happen for this $30 billion market to hit those, multi-trillion-dollar projections?
because if you've ever looked at those high-end investments, private equity, fancy real estate funds, and thought, okay, that's not for me, with the crazy high minimums, the paperwork, this deep dive explains how tokenization might, just might, break down those walls, make things accessible.
Potentially democratize access, yeah. So let's get into it. Where do we start? The big players.
Let's start right there. The institutional heavyweights making their moves.
Okay, so looking at what's happening right now, the real momentum, the big wave, it's
Yeah.
focused. It's about safety, efficiency.
You mean treasuries?
Exactly. Tokenized U.S. treasuries, they've just exploded. It's already like an $8.3 billion asset class on its own. That's really leading the institutional charge right now.
Which makes sense, doesn't it? Treasuries are, the bedrock,
Yeah.
safest thing globally, super liquid. But what's tokenization really adding to something that's already seen as, well, perfect collateral?
Well, it's adding time and programmability. See, treasuries still operate on old school settlement cycles. There are delays, counterparty risk, even if small.
Right, T+1, T+2.
Yeah. Tokenizing them turns them into, essentially, 2047 digital cash that settles instantly. Think about managing collateral globally, across time zones. This makes it incredibly efficient.
So instant settlement, better collateral mobility.
Precisely. It's the low-hanging fruit, really. It proves the tech works for critical operations without taking on massive asset risk.
And you can't talk about this without talking about BlackRock. Their BUIDL fund isn't just dipping a toe in the water.
Oh, absolutely not. BUIDL, that's the BlackRock USD Institutional Digital Liquidity Fund. It's running on Ethereum, tokenizing T-bills, cash equivalents. But the speed, that's the story.
How fast are we talking?
In the last, year and a half, assets grew more than 8 times. 8-fold.
Wow.
And now, that single fund accounts for over 30% of the entire tokenized treasury market.
30%. From one player basically starting from scratch recently.
Yeah.
Is that just BlackRock's muscle, their distribution network? Or does it prove institutions were just waiting for a name they trust?
It's got to be both, hasn't it? I mean, BlackRock manages, what's the number? $13.5 trillion?
Something like that, yeah.
Huge. They have the network, the client relationships, the trust. They can slot these tokenized funds into institutional portfolios seamlessly. It's not just participating, they're kind of defining the standard.
So if BlackRock says DLT is the future for money market funds,
The rest of the institutional world listens and probably follows. It shifts tokenization from being this niche crypto thing to being part of standard institutional plumbing.
okay. Meanwhile, JPMorgan Chase, they seem to be working at an even deeper level, building the tokenized pipes inside the system.
That's a good way to put it. Kinexys, people might remember it as Onyx. This isn't an experiment for them anymore. It's a utility. It's processed. The numbers are wild. Over $1.5 trillion in transactions.
1.5 trillion. Okay, so what is Kinexys actually doing day to day that old systems couldn't?
The key word is intraday, repo, collateral movement. Think about a big bank needing to shift billions in collateral short term. Traditionally, you hit these cutoff times, miss it. Tough luck, wait till tomorrow.
Which is inefficient use of capital.
Hugely inefficient. Kinexes, using tokenization, lets them move that collateral billions, potentially multiple times within the same day, instantly.
So it's about capital efficiency. Liquidity management on the balance sheet, much more dynamic.
Exactly. It's way beyond just parking cash digitally. It's active management of credit and risk using these new rails. It solves a real expensive operational headache.
So it's not just hype. It's solving real problems for the biggest banks. But it's not just BlackRock and JPMorgan, right? Others are moving too.
Oh, definitely not. It's becoming broad-based. Franklin Templeton was actually the first major asset manager to get a registered tokenized money market fund out there, BED-NGI.
Right, BED-NG. How's that doing?
It's already pulled in over $500 million in assets. Pretty rapid uptake. And you've got Goldman Sachs, BNY Mellon, Fidelity. They're all in the game.
And they're mostly starting with these safer assets, money markets, treasuries.
Yeah, it seems to be the common starting point. Build trust, prove the tech. BNY Mellon basically said they see DLT as just the logical next step for handling financial assets. It's inevitable, in their view.
Okay, so the big institutions, the issuers, are clearly on board. What about the buyers, the investors? What's the appetite look like there?
The data we're seeing from institutional investor surveys is pretty dramatic. In 2024, 61% of institutional investors globally said they increased their digital asset holdings.
61%. Okay.
And looking ahead to 2025, even more bullish. 67% plan to increase allocations again.
And are we talking small experimental allocations or something more significant?
That's the kicker. A really significant chunk, 59% of them plan to allocate over 5% of their total assets under management, their AUM, to digital assets next year.
5% of institutional AUM globally.
That's hundreds of billions, potentially trillions, moving into this space. And this isn't just, crypto trading. This is strategic allocation by pension funds, endowments, the big money.
Why, though? Is it the tech, the efficiency, or something simpler?
Mostly simpler. It's the hunt for yield, for alpha. The number one reason they cite expectation of higher returns compared to sticking with traditional low-yield stuff.
So they see upside, both from the assets themselves and maybe the efficiency gains filtering through.
Yeah, it's a combination. Better assets, potentially running on better rails.
Okay, so you have trillions potentially flowing in. That naturally leads to a fight over who gets to hold it, right? The custody battle.
Yes, the custody race. This is where the old guard, TradFi, really meets the crypto-native world. It's fascinating.
You've got the giants like BNY Mellon squaring off against the big crypto exchanges like Coinbase or Fidelity's digital asset arm.
Exactly. And if, say, the early 2020s were about crypto firms trying to figure out bank-level compliance.
Which was messy.
Right. Now, the mid-2020s are about the big banks figuring out how to handle these unique digital assets securely and efficiently. They're learning each other's business.
What are the stakes? What are they fighting for?
Fees, primarily, and control. They charge custody fees, usually pretty small percentages, like 0.05% to 0.15% maybe.
Seems tiny.
But on huge volumes, it adds up fast. The real goal for these big banks, they want to custody the next $100 billion, the next $1 trillion of this digital paper.
Because if you custody it,
you control the flow, the settlement, the data, the administration. It's about building a new defensible revenue stream for the tokenized future. It's a quiet but absolutely critical battleground.
Okay, so tokenizing treasuries, check. Makes sense, efficiency gains, clear path. But the really big prize, the truly disruptive potential that seems to be in the stuff that's traditionally hard to trade, the illiquid stuff.
Absolutely. We're talking alternatives. Private equity, private credit, real estate. These are multi-trillion-dollar markets, but they're historically locked up. High friction. High reward, but high friction.
What are the main pain points with alts today?
Well, first, who gets in? The minimums are often insane. $5 million, sometimes more. That immediately excludes almost everyone except the largest institutions and the ultra-wealthy.
Okay, barrier 1, cost of entry.
Barrier 2,
the
process. It's often incredibly manual. Subscription, documents, redemptions, capital calls. It's phone calls, emails, faxes sometimes. Slow, expensive, prone to errors.
So operational inefficiency.
Right. And third, liquidity, or rather the lack of it. You invest in a private equity fund, you're typically locked in for 7-10 years, maybe longer. No easy way out.
Okay, so how does tokenization address those three things specifically?
Right. It kind of shatters them. Fractional ownership is the big one. Suddenly, that $5 million minimum, maybe it becomes $5,000. Or even less. It opens the door.
Okay, lowers the barrier to entry. What about operations?
Smart contracts. Automate the paperwork, automate capital calls, automate distributions. Everything leaves a digital audit trail on the blockchain. Tamper-proof. Efficient.
Which makes smaller investments viable.
Exactly. Trying to handle a $50,000 investment using the old manual system, the admin costs would eat up any potential return. Tokenization makes servicing those smaller ticket sizes actually profitable.
And that profitability potential is shifting the focus of the big alternative asset managers, right?
Oh, massively. The giants, Blackstone, KKR, Carlyle, Apollo, they're now intensely focused on attracting wealthy individuals. High net worth investors, or HNWIs.
Why the shift? Are institutional pots drying up?
Partly, fundraising has slowed a bit there, but it's also strategic. HNWIs globally control something like $80 trillion in investable assets. $80 trillion. But currently, they only allocate about 5% of that to alternatives. Why? Because of those barriers we just talked about: complexity, high minimums, illiquidity.
So the thesis is tokenization removes those barriers, and that 5% number goes way up.
Precisely. There was some analysis, I think from JPMorgan, that estimated if tokenization helps boost that H&W allocation from 5% just up to maybe 20% of that $80 trillion pool. The new revenue-generated management fees, performance fees, trading fees could be around $400 billion annually.
$400 billion just from increasing access for wealthy individuals.
Yeah, it essentially could quadruple the addressable market for these alternative funds. It's transforming a, say, $4 trillion private market into a potential $16 trillion opportunity. That's the single biggest driver, the economic incentive behind all of this.
That's staggering. Okay, let's make this more concrete. Real estate. Everyone understands property. How does tokenization apply there?
Real estate is almost the perfect use case, isn't it? It's notoriously illiquid. Deals take forever. Ownership records can be messy. Tokenization promises to fix a lot of that.
What are the forecasts looking like?
Deloitte put out a number suggesting around US $4 trillion of global real estate could be tokenized by 2035. That's a growth rate, a CAGR, of about 27% per year.
4 trillion.
Okay,
where does that volume come from? Is it mostly just tokenizing individual buildings, fractional ownership of skyscrapers?
Actually, no. The breakdown is interesting. The biggest slice, by far, is expected to be tokenized debt. Loans, securitizations, things like mortgage-backed securities. That's forecast to be maybe $2.4 trillion of the total by 2035.
So debt first. Then what?
Then comes tokenized private real estate funds. Pooling assets into a tokenized fund structure, that's maybe another $1 trillion. Tokenizing the actual equity of individual properties or land or construction projects, that's smaller, maybe $50 billion or so.
Why the focus on debt and securitizations rather than just, tokenizing the Empire State Building?
Because securitizations are already complex. Multiple parties, intricate cash flows, lots of reporting. It's an area where smart contracts can provide really clear, immediate efficiency wins. The operational gains are easier to measure.
Do we have examples of those gains, like real numbers?
Yeah, there are some good ones. Take reporting for mortgage-backed securities. Traditionally, getting all the data together, reconciling it, reporting to investors and regulators, it can take up to 55 days.
55 days. Wow.
Companies using DLT for this are showing they can cut that down to 30 minutes.
From 55 days to 30 minutes. Okay, that's significant.
And there's another one, Figure Technologies. They do home equity line of credit securitizations on chain. They estimate they save about $850 per $100,000 mortgage in admin and title costs just by using DLT as the single source of truth.
So real, tangible cost savings.
Yeah.
Not just theoretical.
Hard dollars saved. And that brings us to private credit, which is another huge area seeing rapid tokenization.
Right. Private credit is basically non-bank lending.
Yeah, lending directly to companies, often for things like leveraged buyouts. It's a market expected to hit over $3 trillion in assets under management globally by 2028.
And tokenizing it.
It lets institutional investors and potentially HNWIs access these often high-yielding debt instruments directly on-chain, usually denominated in stablecoins for easy settlement. It shows institutions want yield, they want stability, and they see DLT as the best pipe to distribute this kind of debt globally. It's dominating a lot of RWA portfolios right now.
Okay, we've got the market demand, the institutional push, the massive potential in alternatives, but now we need to peek under the hood, right?
Yeah.
The tech. Most people know the basics ERC-20 for fungible stuff like coins or shares.
Right. Divisible, interchangeable, like dollars.
And ERC-721, for unique things, NFTs, like digital art or collectibles.
Indivisible, one of a kind.
There's also ERC 1155, which sort of combines them.
Yeah, the multi-token standard. More efficient if you have, say, different types of items in a game, some common, some rare. Or maybe for like a real estate portfolio where you have unique deeds, but also fungible shares of rental income, all in one contract.
But when you get into complex finance bonds, with coupons and maturity dates, futures contracts, asset-backed securities, mortgage-backed securities with different risk layers, a simple fungible or non-fungible token doesn't really cut it, does it?
Not at all. You need something much more sophisticated. Think about a bond. It's not just a single value. It has a principal amount, yes, but also a coupon rate, payment dates, a maturity date, maybe seniority in case of default.
Lots of data, lots of rules attached.
Exactly. And an asset-backed security, or worse, a collateralized debt obligation, a CDO. They bundle thousands of underlying loans, slice them into different risk tranches, each with its own payment priority. Simple fungibility just breaks down.
So you need a token standard that can handle that complexity, that can hold value and metadata and maybe even rules?
Precisely. This led to the development of what are called semi-fungible tokens, or SFTs. And the standard that's getting a lot of attention for this is ERC 3525.
ERC 3525. The source material called it a universal digital container, or even a super NFT. What makes it different? How does it work?
Okay, think of it like this. An ERC 721 NFT is like a fixed box. It holds one unique thing. An ERC 3525 token is more like a smart container. It's unique itself, like an NFT, but inside it can hold quantifiable amounts of value or different properties.
Quantifiable value inside a unique token.
Yes, and critically, you can split that value, merge it with value from another similar token, or transfer parts of it. That's the semi-fungible part. The container is unique, but the contents can be fungible.
Okay. And it also has this nesting capability, like those Russian dolls.
Exactly. That's the perfect analogy, especially for something like a CDO. A CDO is layers within layers of risk.
So walk us through it with the dolls.
Yeah.
How would you model a CDO using ERC 3525?
All right. The biggest doll, the outer one, that's the CDO itself. That's the main ERC 3525 token, the parent.
Okay.
Inside that doll, you nest smaller dolls. These are the different tranches of the CDO. The senior debt tranche, safest. The mezzanine tranche, medium risk. The equity tranche, riskiest. Each tranche is also an ERC 3520F token, a child token nested inside the parent.
And each child token carries the rules for its specific tranche, like payment priority.
Precisely. The rules are embedded. Senior gets paid first, equity last. But it goes deeper.
Inside the tranche dolls.
Inside the tranche dolls, you nest the tiniest dolls. These represent the actual underlying assets, the individual mortgages, the auto loans, whatever is generating the cash flow for the CDO.
Wow, so layers upon layers, all digitally represented.
Yes. And the beauty is these nested tokens can inherit rules, but they can also potentially be detached. Maybe you want to trade just the mezzanine tranche. You could potentially detach that ERC 3420 title token and trade it while it still retains its link back to the main CDO structure and its underlying assets.
That level of granularity and programmability, it's way beyond just representing ownership.
It's modeling complex financial logic directly into the token itself. It makes tracking cash flows, managing risk, and even creating secondary markets for these complex instruments potentially much, much easier.
Okay, let's apply that power to something else complex and high friction. Supply chain finance. Factoring.
Oh yeah, factoring is a great example. Huge friction there, especially for smaller businesses trying to get paid faster. Verifying invoices, managing payments. It's messy.
So how could ERC 3525 help?
Imagine a company issues an invoice that's an accounts receivable, money owed to them. You could tokenize that invoice, that future payment promise, using ERC 3525.
Okay, so the invoice becomes a token. Then what?
You could structure it cleverly, create almost like linked tokens within the main one, a payable token representing the buyer's obligation, and a receivable token representing the seller's right to get paid.
Okay, like two sides of the same coin.
Sort of. Now, the seller needs cash fast. They can take their receivable token, and because it's an ERC 3525, they can fragment it. Sell off, say, 30% of the expected payment to one factoring company, 40% to another, maybe keep 30%, all tracked on-chain.
So multiple parties can fund the same invoice easily.
Yes, and the automation comes at payment time. The buyer pays the invoice amount into the payable side of the token.
Triggering the smart contract.
Exactly. The smart contract inside the token sees the funds arrive and instantly distributes the money to all the current holders of the receivable fragments, the original seller, the factoring companies, according to the exact percentages they own.
Automatically. No manual reconciliation, no risk of misdirected payments.
Right. It cuts out errors, speeds things up, reduces risk, and makes factoring much more accessible and efficient, especially for smaller players. It increases the flow, the composability of that whole business.
That's pretty powerful. It also sounds like the industry knows it needs standards that are ready for prime time, ready for institutions, compliance-native tokens.
That's the crucial next evolution. You see proposals like ERC 7943, sometimes called URWA or Universal RWA.
Right.
The goal is to build compliance features directly into the token standard itself.
What kind of features?
Things like built-in capabilities to enforce investor whitelists. Only approved wallets can hold or trade the token. Automatic checks for KYSML status before a transfer happens. Maybe even jurisdictional restrictions. This token can't be traded by wallets in country X.
So baking the rules right into the code from the start.
Yes. It signals that the industry is serious about building tools that meet institutional requirements, that can handle the regulatory load needed to move from billions to trillions. It's building for the future, compliant infrastructure.
Okay, we have the demand, the tech is getting there.
Yeah.
But the elephant in the room, always, is regulation. And it's a weird paradox, isn't it? Investors see regulatory clarity as the biggest driver for growth.
Yeah, 57% said that in the survey.
But they also see regulatory uncertainty as the biggest risk.
It's a central tension, absolutely. Because right now, there aren't really bespoke RWA rules. Tokenized assets are being kind of jammed into existing legal frameworks for securities or commodities or banking, often by analogy. And that creates gray areas. Big one.
Where's the biggest pain point for institutions in the U.S. specifically?
Custody rules. 50%, half of the respondents, pointed to crypto custody clarity as the #1 thing needed. Banks need to know exactly how they can hold these digital assets for clients, legally, safely, without tripping over existing regulations.
But haven't we seen some movement there, a slight thaw from U.S. regulators?
We have, yeah. It's been cautious, but significant. The main banking regulators, the OCC, FDIC, the Fed, they've put out guidance basically saying, okay, banks can engage in crypto-related services, including custody under existing laws, if they manage the risks properly.
So not a green light, but maybe a yellow one.
Kind of. And the tone shift from the SEC has been noticeable, too. It feels less like pure enforcement and more like engagement. SEC Chairman Atkins actually told his staff to work with firms trying to issue tokenized securities to find paths forward. That's a big change.
Encouraging innovation rather than just policing it.
Seems like it. And then there's the really big piece coming for the U.S. stablecoins.
Project Yorktown. This could be huge, right?
Potentially massive for RWA adoption. This is the plan to create a federal framework, a regulated way to integrate stablecoins properly into the U.S. financial system. Expected around, late 2025?
October 21, 2025 was the date mentioned. Why is this so critical for RWA?
Because tokenized assets need a tokenized way to pay for them instantly. You need digital dollars for digital assets to achieve that 247 settlement promise. Stablecoins, which already have a huge market cap over $275 billion, are the obvious candidate to be the money on these new rails. Regulating them properly unlocks their use for serious institutional settlement.
Okay, let's hop across the pond. Europe. They have MiCA, the Markets and Crypto Assets Regulation. But it seems to create this split with their existing securities laws, MiFID II. How does that work for a tokenized asset?
It's the first question an issuer in the EU has to answer. Is my token a security under MiFID II, or is it something else under MiCA?
How do they decide?
It comes down to the rights the token gives you. If it acts like a traditional security, gives you rights to profits, voting power, a claim on the company's assets, then it's likely a security token under MiFID II.
So tokenized Apple stock is still treated like Apple stock.
Exactly.
Yeah.
Full securities law compliance needed, broker-dealer rules, prospectuses, the whole 9 yards.
So where does MiCA come in? What does it cover?
MiCA generally covers the crypto assets that aren't securities. Think utility tokens, or crucially for RWA, things called asset reference tokens, RRTs. These are tokens that reference real-world assets like gold, or real estate, or maybe a basket of currencies to maintain a stable value, but without giving you security-like rights.
Like a stablecoin backed by something other than a single fiat currency.
Sort of, yeah. Or a token representing fractional ownership of gold. For these RTs under MiCA, there are still strict rules, governance, transparency, white papers, and really importantly, rules around the reserves backing the token. It's focused on stability and investor protection for non-security tokens.
And regulators globally aren't just writing rules, they're experimenting too. Sandboxes.
Yes, that's key. Places like Singapore with Project Guardian or the EU's own DLT pilot regime. These are controlled environments where approved firms, banks, exchanges, tech companies can actually test trading and settling tokenized securities using DLT, often with temporary exemptions from some existing rules.
So they can learn by doing, see what works, what breaks.
Exactly. It lets regulators gather real-world data to figure out how to update the permanent laws smartly without stifling innovation, but also without creating systemic risks. It's about letting the law catch up carefully.
Okay, but underlying all this regulation is a fundamental legal friction point, isn't there?
Hmm.
This trust problem connecting the digital token to the actual physical asset.
This is probably the single most misunderstood part of RWA, especially for people coming from a pure crypto background, because these are often high-value assets, maybe securities. You must comply with anti-money laundering, AML, and know your customer KYC rules.
Which means these systems can't be fully permissionless like Bitcoin.
No way! Platforms dealing with tokenized real estate or private credit have to verify who is trading. These tokens often fall under definitions of value substituting for currency or securities. So identity verification is mandatory.
And that requirement for KYC/AML,
Yeah.
it sort of clashes with the whole decentralization idea.
Fundamentally. True. Anonymous decentralization often just doesn't work legally when you're dealing with regulated assets like stocks or real estate title. The underlying asset, the actual building, the loan agreement, the company issuing the bond, has to be held legally somewhere off-chain.
By a traditional legal entity.
Usually, yes. Often it's put into a special purpose vehicle, an SPV, or a trust. This legal entity legally owns the underlying asset.
So the token on the blockchain, it's not direct ownership of the asset itself. It's more like a digital claim on that SPV.
That's generally how it works in practice for institutional-grade RWAs. The token represents your legal claim against the SPV or trust based on the legal agreements set up under, say, New York law or UK law.
So you're not trusting just the code. You're still trusting the legal system and the entity managing the SPV to honor the token's claim.
Precisely. It's a trade-off. You sacrifice pure decentralization to gain legally enforceable title and regulatory compliance. That's the model that institutions are comfortable with. You see projects trying to bridge this, but ultimately, for regulated assets, some form of legal centralization seems necessary.
Okay, so the big promise of tokenization, especially for alternatives, is unlocking liquidity, right? Making it easy to buy and sell fractional shares, 247.
That's the dream, yeah. Hyperliquidity for traditionally illiquid assets.
But the research we looked at suggests that right now, today, liquidity is actually still the major bottleneck for RWAs.
It really is. It's the persistent challenge. You can technically move these tokens instantly, but if you look at actual secondary market trading activity for many tokenized instruments, it's minimal.
So people are buying and holding, not actively trading.
Often, yes. You see very concentrated ownership, long holding periods. That vibrant, deep secondary market just hasn't fully emerged yet for most RWA categories.
Why not? If the tech allows for easy transfer, what's holding back the liquidity?
A couple of big structural things, I think. First, the market is fragmented. There's no single NYSE for RWAs. Trading happens across different platforms, different custodians, maybe some private peer-to-peer deals. It's hard to pool liquidity and get good price discovery when it's so scattered.
Okay, market structure issues. What else?
The regulation we just talked about. Because many of these tokens are legally securities, trading is often restricted only to accredited investors or investors who've gone through full KYC or LO.
Ah, so the pool of potential buyers and sellers is limited by law.
Dramatically limited, which is, by definition, illiquidity. The tech provides the potential for speed, but the necessary compliance rules create friction that limits the number of participants. It's a direct trade-off.
So we get more access through fractionalization, but then we potentially limit trading liquidity through regulation.
Interesting. But what if liquidity does improve? Does that create new risks? This idea of volatility spillover. This is a really serious concern for regulators and risk managers. What happens when you take an asset class that everyone thinks of as stable and slow-moving because it's illiquid, and you suddenly make it instantly tradable?
You might import volatility from the public markets into the private markets.
Exactly. The classic example is real estate again. Compare a private real estate index based on infrequent appraisals that look super smooth, maybe shows like 2.8% annualized volatility.
Very stable on paper.
Right. Now look at a publicly traded real estate ETF, a REIT EPF, that trades every second. Its volatility might be over 20% annualized. Huge swings.
That's almost 10 times the volatility for theoretically similar underlying assets.
Yes, so the fear is if you tokenize that private real estate and make it instantly liquid like the ETF, do you suddenly subject it to that 20% volatility? Do you make these historically stable private markets susceptible to panic selling during broader market stress?
Because everyone can suddenly run for the exit at the same time, which they couldn't do before.
Precisely. It brings back memories of 2008, where supposedly uncorrelated assets suddenly became highly correlated and highly liquid on the way down, amplifying the crash. So managing this potential imported volatility, maybe through circuit breakers or other market structure rules, is going to be critical.
To handle that, is the industry making distinctions between how securities end up on a blockchain?
Yes, there's an important difference emerging. People talk about tokenized securities versus security tokens.
Okay, what's the difference?
Tokenized securities usually mean the asset was issued and is custodied in the traditional way like a normal bond, but then a digital twin or representation is created on a blockchain just to make transfer and settlement more efficient. The primary record is still off-chain.
Got it. And security tokens?
Security tokens are designed to be issued and live natively on the blockchain from day one. The token is the primary legal record of ownership, held only on the DLT.
And the compliance, custody, and risk implications are quite different for those two approaches.
Very different, yeah. The natively digital security token potentially offers more efficiency, but also raises deeper questions about regulation and infrastructure.
Okay, one last point before we wrap up. We mentioned stablecoins as the grease for the wheels, the settlement layer. But the Bank for International Settlements, the BIS, basically the central banker's bank, they have some pretty fundamental criticisms, don't they? They're questioning if stablecoins can ever be true sound money.
Yeah, this is a deep theoretical challenge from the heart of the traditional financial system. The BIS acknowledges stablecoins are useful for payments, for trading RWAs, but they argue stablecoins fundamentally lack three core properties of a robust monetary system: singleness, elasticity, and integrity.
Okay, let's break those down. Singleness.
Singleness means money is money. A dollar is a dollar, universally accepted at face value within its jurisdiction, guaranteed by the central bank. Stablecoins rely on the issuer's promise to redeem 1.1. That promise isn't universally guaranteed, and if you have dozens of competing stablecoins, you lose that single unit of account property.
Makes sense. What about elasticity?
Elasticity is the financial system's ability to expand and contract the money supply based on economic needs, usually through bank lending, fractional reserve banking. Stablecoins are generally fully reserved, meaning they can't easily expand the money supply through credit creation in the same way banks do. They lack that dynamic responsiveness.
Okay. And the third one? Integrity.
Integrity refers to the absolute certainty and finality of settlement, especially in a crisis. The BIS view is that only settlement in central bank money on the central bank's books provides the ultimate level of safety and stability for the core financial system. While regulators are working hard to make stablecoin reserves safe, there's still a philosophical gap between a private stablecoin and central bank money in terms of ultimate systemic integrity. It's a fundamental debate about the future structure of money. #outro.
Wow. Okay, that was a lot to unpack. A really necessary deep dive, though. We've gone from BlackRock's fund hitting massive scale to the nitty-gritty of ERC 3525 tokens modeling CDOs.
Yeah. I mean, the big takeaway, this RWA tokenization thing, it's not theoretical anymore. It's happening. We're already at nearly $30 billion on-chain value.
And the forecasts are just huge, potentially $18.9 trillion by 2033. That's a compound annual growth rate over 50%. Mind-boggling numbers.
Driven by that institutional need for efficiency, for instant settlement, and crucially chasing that $400 billion annual revenue prize by unlocking private markets for more investors.
The tech, like ERC 32525, seems ready to handle the complexity.
It's getting there, yeah. Modeling complex finance on-chain is becoming feasible.
But it all comes back to regulation, doesn't it? Getting global alignment on custody, on what's a security, and figuring out that tricky link between the legal asset held in an SPV and the digital token, that trust problem.
That's the race. It's not if this transforms finance anymore. It really feels like when it becomes a dominant way of doing things, solving those regulatory and legal hurdles is the key.
So we've talked a lot about tokenizing bonds, funds, real estate today. But if the ultimate goal here is this 24/7 instant programmable financial system that cuts out waste, I want to leave you with a final question to think about.
Yeah, think about your own financial life. What essential financial service that you use regularly, maybe how your mortgage gets serviced or your insurance policy functions, maybe even how your company handles payroll. What's the next everyday financial process that could be fundamentally reshaped, made faster, cheaper, more transparent by using smart contracts and tokenized ownership? Something to chew on.